Okay, guys, welcome to the lecture 3 of our 5 lectures course. In the first lecture, we had covered support and resistance and how to spot entries using support and resistance. In our second lecture, we covered a candlesticks analysis and 2 chart patterns and how to use them to spot entries and exits within the market. So these first 2 lectures were your prime analysis. Your prime analysis, guys. Prime analysis will always be this: support and resistance, candlesticks analysis, guys. That is your prime analysis. Remember, whenever you take a trade, always you need to first point of analysis will always be prime analysis, support and resistance, candlesticks. Then secondary analysis. You can use secondary analysis, find confirmations of your trade, of your prime analysis. So if you found an entry on the prime analysis, you can see from the secondary analysis if you further get confirmations. Together, if you together combine it, you call it confluences. Confluences, more than one reason to enter a trade. More than one reason to enter a trade. Now remember, if there is an signal from the prime analysis to take a trade and you do not have any signal from the secondary analysis, you still can take the trade because prime analysis is the prime price action. But remember, guys, if you have secondary analysis telling you to take the trade, like 16 secondary analysis telling you to take the trade, and your prime analysis is telling you there is no signal, then remember, guys, you never take a trade. You never take a trade. Now, write yes and tell me if you understand what I'm saying. Then, Ali, Khudayar, Zen. Good. Now, secondary analysis, what it is? Secondary analysis can be any indicator, stochastic, Bollinger Bands, RSI, awesome oscillator, escalator oscillator, market fractionation, volumes, MACD, bulls power, bears power. Any indicator is a secondary analysis. You understand? It's a secondary analysis. We add them to our trading. We add them to our trading to see further confirmations, because remember, when we take a trade, we need to have more than 3 to 4 reasons, 5 reasons to take the trade. The more reasons we have, the solid the setup is. You understand what I'm saying? So remember, the bottom line, prime analysis has to be followed, has to be kept supreme, respected. Do not diffuse it in the secondary analysis. Has to be the prime analysis always, and then add on. In the prime analysis, I'm going to add the last topic, which is supply and demand, which is slightly different than support and resistance levels. And then in secondary analysis, guys, what we are going to teach, I can teach you any indicator. Ichikomi clouds, I can teach you. Bollinger Bands, I can teach you. I can teach you any indicators because I almost practice during my training years. Try all indicators one by one and see the results. But the best thing is, guys, use just 1 or 2 of them. You don't need a lot of them, because the problem is the more indicators you have on your charts, and if they give you 16 reasons and your prime analysis is not telling you, sometimes your mind will think, let's take a trade, because secondary analysis is telling you. Yes, I'm giving you the ones which all institutional traders use. Normally, they don't even use it, but institutional traders normally use, and they are leading indicators, not lagging indicators. Leading means who tells you the future, lagging means who are telling you what is happening. Understand, guys? I'm going to teach you RSI today, which is Relative Strength Index. Also tells you of divergence. Now I'm going to explain you what divergence means. That is our topic for the day, and then in the next topic we will add more. But that is the topic of the day, and then we will apply all these together, and try to find the entries within the market. I already showed the entries using support and resistance and candlesticks. You guys know exactly. You guys sent me the homework. That was pretty good and impressive. But remember, guys, let's build upon it, add on to it, to have more confidence in our trading and our setups. Understand, guys? Any questions? Very good. Okay, I'm going to start first of all with supply and demand, guys. Now, support and resistance levels, what are they? I explained you guys, support and resistance levels are a point of reaction within the market. There are many support and resistance, but we are more focused on the ones which are significant, which are institutional, which are the ones used by the bankers and institutions to move the market. So the point of reaction is the one, support and resistance, I explained. A point where institutions come into the market. Yes, guys, you know already of this. Yes, say yes. Good. Now the second I explained is the point of failures. Now where institutions, big bankers, big boys fails, the levels where they fail and establish a wick, they always try to go back to that level, and that is why we call them a point of failures, which means wicks on your charts has to be marked in support and resistance. Understand, guys? So point of failure, point of reaction, these are normal support and resistance. Do you understand this? Right, you must know already, because I have given you enough understanding, enough lecture on this, enough practice on this. Yes? Khudayar, confirm me, please. Good. Now I'm going to tell you what is supply and demand. Then the question is, supply and demands are zones. We establish them as zones. The question is, what are supply and demand zones are, and what is the difference between them and support and resistance? Now remember, guys, this is what supply and demand zones are. Supply and demand zones are the areas in the market where institutions and hedge funds and big bankers traps retail buyers and retail sellers. You understand? These are zones within the market where big boys trap retail buyers and sellers, retail participants. They trap them. They trap them. Now you understand, guys? Institution trapping the little boys. Institution trapping the little boys. You understand what I said? Tell me. Yes, they do. They do. The institution's job is this. What they do all day is this. One after a session, one from one session, they tell them, look, we have trapped this much orders. Now your target is to trap another this much orders in the next session, and then follow into the next session. And exactly that is what they are doing all day, all night. You understand? Do you understand? Now let me give you example of trapping. What the trapping means. I'm gonna give you an example here. All can see the screens, right? This is your resistance, that is your support. Market is going up. Now, what the trap means, understand. If you do not understand, institutionally, you cannot trade successfully. Now, market is reaching the resistance level. Now, for instance, let's say this is a strong bullish candle. Then you have an engulfing candle. Then you have another engulfing candle. So what the retail traders will do, they will start buying here. They will start buying here because they think that the resistance has turned into a support, firstly. Secondly, candlesticks analysis telling me a strong bullish momentum within the market. So let's buy. And the institutions will keep on taking the market around these levels with strong bullish momentum in order to incite, attract retail buyers to accumulate and place more orders here. So if you are a retail trader, you'll open up more orders here thinking this resistance has turned into a support, right? Bullish candles explaining me the market is going to the upside. So let's open up more orders. For instance, if somebody already in trades here, they'll open up and add on more orders here. If someone is not already in the trades, then they will open orders around these levels. I'm sure 87% retail traders exactly do this. Everyone does it. You guys would also do this exactly. All you'll say, the market is above the support level. Strong bullish momentum, candlesticks, right? Let's open up the trade. Let's buy from here. No reversal. It's going to another level. That's how you think. Understand, guys? Do you understand, guys? Now, what institutions will do? They will take the price up, attracting more orders, right? So all the retail support sellers and buyers participants will have their stop loss around this area. You understand? So they have their stop loss around this area, and they have their buy orders there because they think the market is going up. Yes? Understand? Understand? Do you understand? Good. Now see this. They will use an event. The market makers, the institutions will use an event to manipulate the market and trap the buyers and sellers. How do they do this? A news will come. They will suddenly push the market down. Hit your stop losses. Push the market down. Hit your stop losses. Yes, they will hit your stop losses. Take out all your stop losses. All your stop losses, right? And then may take a market to the upside again. That is one way. That is one way of explaining how to trap. They will hit your stop loss and take the market up again. So what will happen? When this candle will close, the one which takes out your orders and goes up again, it will be something like this, like a hammer. You understand what I'm saying? It will be like a hammer. The market suddenly spikes down, takes out your orders, takes out your stops, and goes up again. You can also call it a stop hunt. Yes, a stop hunt. I'm going to explain you how the support and supply and demand levels been established. What is the difference between them and support and resistance? Understand what I'm explaining. I'm coming to it. So market will rising. A lot of retail traders had placed their orders around here, stop loss just below. Suddenly a market user news, hit your orders and goes up again. When the candle closes, it will normally be what candle? Which candle? A candle with a strong wick, a candle with a strong shadow, right? Hammer, for instance, hammer. You understand this? It will be like a hammer, right? A long wick. Yes? Do you understand? Yes? Now, and market, this is the first scenario. The market will continue to the upside. That is the first scenario, guys. The market had to go to the upside because remember there was strong bullish momentum. The market retested support level, right? Many reasons. A lot of buyers came into it. Institutions also want to take the market to the upside. But what they'll do, they'll trap the retail buyers. They kill the retail buyers before they go up to the upside. So they nail their money. They bank their money by killing your guys, remember. And they'll do a stop hunt. Market will come down, spike down, hit your stop losses, and then eventually keep on going to the upside. You understand? Because they can see your stop losses on their screens. You understand this? They can see the stop loss on their systems. Any questions so far? I'm going to establish a supply and demand zone now. Do you guys understand? Do you guys understand? Khudayar. So that is how they make money, by hitting your stop losses. If you have a stop loss hit with your broker, where does that money goes? To your broker, right? Exactly. And that is how they make the money. So you lose the money, somebody gets the money, right? You lose the money, somebody else gets the money. But that is it. Understand? You don't have to go into a detail here or depth. You understand? You lose the money, they make the money. You make the money, they lose the money. Simple as. Understand? Good. Now, guys, what will happen? This is the first scenario when the market does a stop hunt and continue the direction of the trend. Understand, guys? Now the question is, where is supply and demand zone? So remember, guys, the stop hunt, the stop hunt, the stop hunt, the stop hunt is your demand zone now because market has gone up. You understand? You will zone this point, zone this area, the spike area of that candle, which is a demand zone. Now, let me say why we mark the demand and supply zones on your charts. The demand zone is established when it is a continuation trend. The market goes to the upside. So you will establish a zone. This zone will call a demand zone when the price is above it. Understand, guys? You just establish that zone, mark that area in which they went down to hit your stop losses. You understand? And that zone is called demand zone. Now, the question is this. Why do we mark the supply and demand zone? Yes, this is a question. Everybody thinks about it. But let's establish a supply zone first. Let me give you an example of a supply zone first. This marked area is a demand zone. Now, how can it be a supply zone? Let me give you an example again. See this. Do you guys understand so far? Do you guys follow me so far? Explain, tell me. Dan, Ali, Khudaya, do you understand? Ali, I can't hear you, so it's fine. So let's say market is going up, market is going up, up, up. The retail traders has placed their buy trades here. Stop loss just below, right, guys? Buy orders are above this support level. Stop loss just below. I'm giving you an example of another. There are always two scenarios. Market is going up. So you all think the market is going to the upside. Yes, it is going to the upside. Reach the support level. Strong institutions. It looks like institutions within the market. Strong candlesticks analysis telling you bullish momentum. You all start buying there. Retail traders buying there. Institutions are buying there. So the market is going to the upside. Yes. But then suddenly the market spikes down on any news and take out your stop losses. You understand? Takes out your stop losses. And then market continue moving to the downside. So that move to the upside is a fake move to attract and trap the buyers. Trap the buyers. Trap the buyers here. Everyone was buying and suddenly market spikes to the downside and continue to the downside. Took off their orders too. You understand? So when this candle closes, the area of manipulation, the area of price manipulation, the spike, the sudden spike, the kill move, which kills your order, we establish a zone there. Let's say if this was the spike, so we mark a zone here. That zone is called supply zone now because price has moved to the downside. If the price has moved to the upside, it's a demand zone. If it is above the price, it's a supply zone. Below the price, it's a demand zone. Understand? Do you understand? This is an example of supply and demand zone, how they are established, the zones, how they are established. The price manipulate, takes your orders. I'm going to explain you again. Trapping buyers. What is trapping means? Market was going up. Everybody thinks it is going up. You place orders. You have stop losses here. And suddenly market suddenly spikes to the downside. Hit your orders. And either continue going to the upside or continue going to the downside. So they trap. Let's say the market starts going to the downside. The buyer's orders had been trapped here. The trap means where a lot of stop hunt took place. A lot of buyers and sellers stop losses were taken by the market makers. You understand? Do you guys understand what I'm saying? Do you guys understand? 100%. Do you guys understand? Not a little. If you don't understand, ask me a question because I'm gonna move on and explain it further. Good. Now listen this. The question arises. Everybody ask me a second question now. Why do we mark supply and demand zones then? That has not been explained in any training yet. What I'm explaining, the way my approach is entirely different. I'm trying to make you see the institutional way, the real institutional way. It already has the market maker method within it because I balance it pretty good. Now the question is this. You'll ask me a question. Why do we mark these zones? I explained why do we mark strong reaction. Why do we mark point of failures, point of reaction in support and resistance? And the question is, why do we mark supply and demand zones? Guys, if you do not know the philosophy behind it, there's no point in putting them on your charts. Now remember, guys, market is moved substantially by the institutions, the bigger banks, right? But certain percentage of market is also moved by the retail and small traders. Let's say 15 to 25%. They also move the market. We also call them weak holders. So the market is moved by the strong holders, institutions, and also by the weak holders, retail traders, little hedge funds. They have accumulatively, they push the market sometimes to certain places. Do you understand? So we mark these zones. Now, why do we mark these zones? Let's say I've marked this zone. The reason, I'm going to tell you the reason. Reason number one, because you have orders trapped here. Orders are trapped here. And the price has gone down. The retail traders will try to push the price back to these levels again, release their orders if they have any. One reason. Understand, guys? Do you understand what I said? The retail traders, the small weak holders, will try to somehow bring the price back to these levels again to release their stuck orders. Understand, guys? Zen, do you understand? Now see this. So this is a point of attraction because of that reason. Secondly, institutions can also suddenly move the price back to this area again if they were unable to take out all the orders for the first instance when they had the first move. So they might want to go to this point again. So let's kill the remaining 25% or 30% there. So that is why this is a point of attraction. Do you understand this? This is what? A point of attraction. Yes? And then again, Sometimes there's another reason. The weak holders are going up again to release their orders. To release their orders. Then when the price almost reaches around this level, institutions kick in and say, no, we won't let you do it again, and suddenly move the market to the downside. So that is the third reason for this level to be very attractive for entries and exits. Yes? Does it make sense to you guys? Does it make sense to you? Do you know this, understand the significance, the importance of these levels within the market, these zones within the market? Weak holders might want to go back to that area, so they want to take the price to that area to release their stuck on orders. Institutions might want to go to that area again because they didn't kill the all orders in the first instance. They want to kill the remaining orders. Or maybe the weak holders are moving the market to that area again, but institutions suddenly came in and said, no, we're not going to let you release your orders. Let's kill it again. And suddenly you see a sell-off. So there are three reasons. Are you guys clear with supply and demands levels, and why do we mark them on our charts? What is their difference between support and resistance? What is the difference between them and support and resistance? There's a significant difference. I'll just explain it to you guys. Totally a different concept, different reasons. Do you understand it? Tell it to me. Do you understand it? This is an institutional way of trading. Do you understand it? Yes. 110%. Do you understand it? Not a single second, microsecond understanding is if it is missing. Need to ask me a question now. I'm working really hard for you guys to understand, to become a better trader. And trust me, you follow me, you be a better trader, nail the market every day, but need to know the reasons behind it. So if somebody asks you a question tomorrow, what is the difference between supply and demand and support and resistance? Will you be able to explain it significantly in a very comprehensive manner? Would you be able to? Say yes or no. Khudayar. Do you understand? I'll leave it. How do I explain it? My question is, yes, this is what I want to see. Leave it. Don't praise me. My earnings tell me about my strength. Guys, wait a minute. Let me take my cigarette first. Let me open the voice. And Ali, tell me if you understand it completely. Ali, do you understand so far?
I understand him.
100%.
Maybe.
Good. Okay, now. So that is why we mark supply and demand levels on our charts. Now I'm going to explain you and give you examples of marking them on your charts, which is exactly the way Ryan marks, and there's no difference. There's no difference, exactly the same way. Normally, I personally suggest to you guys to go into 4 hours time frame and always mark them, because you don't want to fill your charts just supply and demand levels, because they are always everywhere. 4 hours time frame, guys, major supply and demand levels, and mark them. Where was the major reaction? You mark them where? Mark them on a major reaction. This is important. Mark them on a major reaction. Let me give you an example. Market reacted to the downside. This is a major reaction. Just always do on 4 hours. It's easier. So this is the trap. Understand, guys? Understand? Look, there is another supply and demand zone. Yes, it is. You can mark it. But normally, I like to mark where the significant reaction takes place. So if you mark this or this, there's no difference. They're just close to each other. So not to complicate your charts, Mark them where is a significant reaction to the downside. There was no reaction here. Market continued to the upside because market trapped orders here, but then weak holders released those orders by taking the market to the upside. You can see, but institutions comes in here, all trap orders, all buy orders here. Then it with this move, yes. So that is your institutional level. Then market trapped the orders here again. Everybody was thinking the market is going to the downside now, strong reaction. Break of the trend line, many reasons, shooting star, bearish engulfing. Everyone thinks, and suddenly the market trapped these orders, and took the market to the upside because everyone will have their stop losses around these areas. Yes, because of this move, everyone had moved their stop loss around this area. The market suddenly moved the market up. The participant moved the market up, killed the sell orders, and then again continued to the downside. So the move was triggered from here. So that wick is significant. Understand, guys? Also, so how to mark on your charts from a major point of reaction, just mark the wicks, and that is it you need to know. As far as the marking is concerned on your charts, to make it simpler, do not go into a detail. The detail I had given you is so that you can understand the difference between supply and demand and support and resistance. Now just learn how to mark them, a Ryan method, which is pretty decent and easy, and that is all you need. Understand, guys? Significant levels. See this? This is a significant move to the downside. The significant move to the downside, this first candle. This candle triggered the move, this first bearish candle. And so that is what it is. A bullish move and suddenly to the downside. So this is again a zone. And can you see how the price reacted from this zone again? So you don't overcrowd your charts with supply and demand levels, guys. If you overcrowd your charts with them, then you might forget to focus on trend support and resistance and candlesticks analysis. Yes, it is easier to mark on 4 hours time frame because the reason, Jan, is it is this. It is a decent time frame. It is not too zoomed out and not too zoomed in. And because you're trading on 4 hours and going into 1 hours, it is easier to trade with. Let's say if you mark on your 1 hour time frame, then you'll have so many zones here that you will not understand how to trade it and you'll get confused. Understand? I can mark on 1 minute time frame also. But then again, this is me, not you. For you to keep it simple, always mark on your 4 hours time frame, which is a decent zoom out. You will not have too many zones, not too many zones. Otherwise, they're so confusing. They are so confusing. Yeah, soon. Yes, definitely. I like that. See this. I'm just marking the zones. If I already have these levels from the previous, I won't have to mark here. Can you see these zones? Can you see this? Everybody bought here, it came down, did a stop hunt. Take out the orders, right? Take out the orders and took the market up. That was your support. Everybody will buy here. Look at the candles. But then suddenly they manipulated, took the market down, hit the stop losses, and took the market up. So all you need to do is understand. You guys understand the concept of supply and demand and how to mark them on your chart. Say yes to me. I'm moving forward. This is not going to be a very long lecture. Khudayar.
Yes.
Good. The next topic, guys. Divergence. I'm going to explain these two topics quickly and give you a few examples on your charts. How we use them to spot entries and exits. Got it? relative strength index I want you to use. Relative strength index. Go to your charts, indicators, oscillator, relative strength index. You can use MACD, you can use stochastic, all are fine. I'm explaining you how to use relative strength index. So this is your relative strength index, guys. Can you see on your charts? Can you see on your charts? Now, relative strength index tells you the strength of the trend. It gives you the strength of the trends, and that is what relative strength index means. Now, remember, guys, it gives you the strength of the trend, and that is significantly important. It gives you the strength of the trend. It doesn't give you an overbought and oversold areas. That is a wrong concept. You must always follow the strength of the, it gives you the strength of the trend. It doesn't mean overbought, oversold. Wrong. It's above 70, it's overbought, oversold. Below 30, overbought. These are bollocks concept, wrong concepts. Relative strength index by its name tell you the strength of the trend. Now, uh, understand this. When the price is at 30 and it start moving towards the upside, okay, when the price is below 30 and it start moving towards the upside, what does it mean? Tell me, Zan, what does it mean? It was below 30 and it start moving towards the upside. Tell me, what does it mean? Khudayar, you also tell me what does it means. Right? Tell me. No, this is wrong. Not stronger. Wrong. You, Zan. It is right to a certain extent, Khudayar, but not the right interpretation. Zan. Quickly, Zan, you're not answering. Zan. No, divergence is something else. Zan. I think Zan is gone out of the. Let's, guys, give it a minute. Okay, that's fine. Do not type. It's fine. Just leave the typing side. Zan, can you hear me now? Speak up. Okay, that's fine. Okay. Now, understand this, guys. When on the indicator the price start moving towards upside, it means the price is picking the strength. It starts showing its strength. Yes, it is getting stronger. You was right, but that is not how you say it. It has start showing the strength. The strength, not changing, showing the strength. How does it show the strength? Let me give you an example. Price is moving. Price haven't started yet moving to the upside. It's on the support level. No much movement on the price, but indicator is rising. It means here this price, even though there is no movement on the price yet, the indicator is telling us, because it is rising on the indicator, it is picking the momentum, picking the strength, picking the strength. You understand, guys? You understand now? So even if the price is not moving, the indicator is getting above 30. It means that this, though you cannot see yet, is getting strength. You understand? Now it start going up, up, up. More it goes up, stronger this trend is. You should not be selling based on this indicator, because it's a strong trend. This trend, this move to the upside is strong in strength. And remember, guys, when it's above 50, it's even stronger. You understand? So it was stronger, it was weaker when it was 30. It's getting stronger now. It's getting stronger. See, it's getting stronger. It's getting stronger. And when it is above 70, it is the strongest. It is the strongest. So guys, the price above 70 is the strongest. Do not ever sell if it is above 70, or do not ever buy if it is below 30. Below 30 means it's the weak. Above 70 means it's the strongest. You can never sell in the strength. A lot of people start selling when the price reaches above 70, right? Wrong. You shouldn't be selling. You understand what I'm saying? You understand what I'm saying? Use the right way. The indicator has to be used above 70. How can I sell something when it is at its extreme level? Above 70, the price can remain above 70 for 500 pips move. So would you sell it just because it is above 70? Absolutely not. It will kill you, right? It will kill you. Again, similarly, when the price comes below 30, it's very weak, very weak. You say, okay, it might reverse. Let me buy. Don't buy, guys, because below 70 is the weakest. You need to start buying when the move starts showing you some strength. Price is here. Would you buy? You don't buy if it's below 30. The reason is it's showing weaknesses. It can suddenly dip to the downside. And also, this indicators can stay below 30 for another half an hour, 40 minutes. So you're not going to sell it just because it's below 30, it's pretty weak, or buy it because it is below 30, pretty weak. Buy it because it's just above 70. No, guys, above 70 is extreme power and below 30 is extreme weaknesses. Never do that. Never do that. They can remain in extreme, above 70 in extremely strength areas and below 30 extremely weak areas for hours. For hours. You understand, guys? Do you understand, guys? Do you guys understand? Now the question is how, then when, what should we
Yes,
do?
Mokan. Yes.
You will sell when the price first time reaches below 70. This shows the weaknesses has started. You understand? Remember, very important, guys, very important. A lot of time you guys just start this is the top, let me sell it, and price go another 100 pips up first, kill you first, then come back. It always comes back, but then it kills you. Don't. Using this indicator, which is a secondary analysis, I'm just telling you how to use this indicator right now. That is it. You sell it only when the first time after price remaining in above 70, it comes back. Let's say the price went above 70 here, just based on this indicator, and came down. Would you just sell it? Be conservative, guys. You want to see the price goes up, price comes down, then goes up again, maybe. No, I'm just discussing this indicator right now. No primary analysis I'm discussing. Just focus on this. The price goes up and come back down to 70. It show me a weaknesses to the little extent. Wait for the price to go above 70 again, or make a lower high here, guys, lower high. Then I will sell. Or maybe price goes up, price come back, fail to go up again, then I will sell, guys, because it confirms the weaknesses not on the first dip. You understand? It went up, came down and went up again, right? Had you sell on this, you had been gone. Look how the market went up again, 140, 50 pips. So wait for the price to come back and try to make another low, higher low, lower high, higher low, lower high, and then sell it based on this indicator, guys. Remember, this way indicators, secondary analysis is never 100%. Use it to add on. Do not trade with it. Do not trade with it. I'm explaining you the right way of using this indicator. But remember, guys, this what I'm teaching you right now is not leading, it's lagging. It's lagging. So remember, it is developing with the price. So it is not telling you exactly the future. You understand? It can tell you to a certain extent, not everything. So use it as a secondary analysis. It's a lagging indicator, not a leading. So the rules are this. If you see something like this, then you can sell with confidence based on your primary analysis. But also under these circumstances on the indicator, with my primary analysis, if I see these together, I am a very happy person. You understand what I'm saying? Do you guys understand? Now, guys, this concept leads to another thing which you need to do, which is called divergence. And what is divergence? Divergence is a hidden strength and hidden weaknesses within a move which we cannot see on our charts on the price action. It is an accumulation of strength and accumulation of weaknesses, which we call it divergence. It is visible, it is hidden at times. I'm showing you only a basic concept to follow, a very basic concept to follow, guys. Now, I'm going to teach you on divergence, but tell me before, do you guys understand the first method of using relative strength index? Say yes. Say yes, guys. Khuda yaar. Leave the periods. There is no advantages. Just use your standard settings. People tend to change the settings as they think, but that is not something I advise. It makes no difference unless you can read the indicator. If you can read the indicator correctly, then that is all you need. A little settings would make a difference because understand, this is not your primary analysis, right? I do not use it to trade. I just use it for a reference, just to see add-on. That is it. You understand? So I'm not concerned with settings too much because this is not something my prime focus. This is just an add-on. I don't even use it at times to trade. You understand? And if you start focusing on this indicator, you will be F upped. You will have losses. You understand, guys, what I'm saying? Any questions so far? Any questions? Zan? Zan, any questions? Okay. I'm briefly giving you example again. Below 30 is extreme weaknesses and above 70 is extreme strength. Never sell into weaknesses, never buy into weaknesses, never sell into the strength. Point number one to take. Secondly, when do we start selling? When the price is in extreme level, it falls and dips below 70, do not start selling based on the indicator. No. Wait for the price to make a lower high. It will go back sometimes. And if it comes back, this is an ideal selling. It confirmed the weaknesses now. And exactly, the price came down and went up. Do not start buying. Let the price to make a lower high, higher low. Opposite to this. This confirms. And when the price comes above 30, you start buying. You understand now? Do you understand this? The price go down, you don't start buying. The price comes back above 30, you don't start buying. It goes down again, don't start buying. It's showing weaknesses, but then it comes back and it makes a higher low, you start buying. You understand now? Tell me you guys understand how to use this. Okay, now I'm going to show you the concept of divergence first. Divergence tell you the strength in the price action and weaknesses. I'm going to keep it pretty simple for you guys, not to complicate these too much secondary analysis, because I don't want them to be in detail. Yeah, only the concept you need to take is this: the price is going to the upside, guys. So the question is, the price is rising. It's strongly trendy, making higher highs, higher lows. The question is, shall I start selling? Because this trend, is it a strong trend? When does it loses its strength? This trend, maybe the price action on the charts does not show you the trend has changed, but something can tell me this rising move to the upside is losing the strength. Divergence can tell you. How can it tell you? If the price is rising, and making higher highs on your indicator, somehow the price is making lower highs, guys. Start making lower highs. This, so from the price action on the charts, you cannot see any weaknesses, right? You cannot see the price is making higher highs yet. It hasn't started making lower highs. But then if on the indicator, the price start making the lower highs, this high is lower than the previous, it is telling me the price had started to lose the strength. This move to the upside has losing its strength. And at any stage, at some stage, this will fall to the downside. On the price action, you might see the price making lower highs at a later stage, at a later stage. But then on the indicator, it might tell you beforehand, and you might have a good entry. Or if you're already in a long trade, you want to think about getting out of the trade. But based on your prime analysis, this is just an indication of what might will happen, not a definitive. It might will happen, and when it will happen, the price action tells us. No indicators can tell us. But this is something which can tell you, oh, this move to the upside is losing its strength. Do you guys understand? Because you cannot see on the price action the weaknesses. The problem is because price is making higher highs, higher lows, right? But sometimes on an indicator, when the price making lower highs and lower lows, it can suggest to you a little that this move to the upside possibly losing strength, possibly, again, not definitive. Remember, not definitive. Understand, guys? So this is divergence. Simple. I'm giving you another example to the down in the downtrend. Price is falling down, making lower highs, guys. A strong trend. Now you cannot see on this. You cannot see on this if this move to the downside has lost its momentum because price is making lower highs and lower lows. But maybe on an indicator, the price is start making lower highs, higher highs, higher lows. If you see this on your indicator, your move still hasn't shown you yet. There is a possibility that this move to the downside has lost its strength. You understand, guys? You guys understand? 100%. Tell me 100%. 100%. Now, guys, continue to my
100% Wakar.
continue to my analysis before combine it. The way I'm teaching is combining together because I want you to focus on divergence more than on the strength. But automatically, if you combine my analysis, going back to my charts, what I said, if you see this, it tells you two things. Analysis number one on the RSI, it has possibly losing its strength. Also, you can see the divergence. Yes, you can also see the divergence. Price is making lower highs, right? So connect to my first teaching of this indicator. Now add on. All you need to add is divergence. Automatically, this is negative divergence, right? So you can sell with confidence. Likelihood is the price will fall. Divergence, how long it stays divergence? As long as the price fails to break this and goes up, then breaks to the downside. Yes, this is negative divergence, bearish divergence. Yes. We don't care what's happening. Maybe the price is rising like this. What we care is to want to see this. Remember, you cannot just take a trade on divergence. The reason is divergence start showing on your chart, on your indicator, maybe for 3 hours before the price moves. So you cannot sell 3 hours earlier before the price starts falling. So you need to wait for the confirmation on the price action. But then again, this will tell you, yes, there is a possibility. So you can add and write on your chart, on your booklets when you're trading. And you keep that in your mind and then wait for the price action to give you a reason to get out of your buy trade or start selling. Makes sense? And then guys, see what I said, the price comes below 30, weaknesses, do not buy. Goes up again, do not buy. Come back again, do not buy. If it makes higher low It goes up above 30, or I said buy, but then also it is a divergence. This is called positive divergence, right? Even if the price is falling, we don't care. This shows me that this move to the downside has lost its strength. Two reasons. First, the strength index telling us. I told you the rules. And if you follow the rules I follow, automatically it show you the divergence automatically. Does it not show you divergence here? Negative, negative, positive, right? Does it make sense, guys? Does it make sense? 100%. Good. That is how you can use relative strength index. Now, before I give you examples of this, I'm going to talk 2 minutes on this. Remember, guys, what I said again. Relative strength index is an indicator. It's not a leading indicator. It's a lagging indicator as far as the strength is concerned, because it shows the strength with the price action. The strength it shows you is calculated based on the price action. So it cannot tell you the future. So remember, do not trust it too much. Divergence is something which is leading to a certain extent. But the problem with divergence is if you see divergence on your indicators, it does not mean the market will start falling the moment you see it. It may fall, but it can take 4 or 5 hours. And sometimes that negative divergence setup can fail. Let me give you example. So you cannot solely trust divergence. Price is making lower highs, right? Showing negative divergence, right? But then price, what if the price goes here? You're thinking it's a negative divergence and it breaks to the upside on the indicator. So here, this negative divergence suddenly fails. Anything is possible. Remember, do not just trust on divergence. It is a good add-on to your reason confirmation. But remember, the prime analysis has to be candlesticks and support and resistance and price action. Understand, guys? This is just to add on. Understand, guys? Tell me. Oh, guys, it's difficult to give lectures. Really, I have to yell it. I'm yelling it for you guys, so you guys become a better trader for your good, not mine. Now, RSI, use it on daily time frames. I do not use it too much. But then again, focus on 4 hours. Divergence on 4 hours is pretty decent. Trade into 1 hours. I do not like to see divergence indicator less than 4 hours because there is no point. So guys, I'm giving you example here. Adding on our support and resistance from lecture 1. I'm giving you examples. This is called confluences. Now confluences, what confluences means? Adding on reasons, more than one reason. I'm giving you example of support and resistance, supply demand, and now divergence, adding on the charts and showing you. Who have taken my lectures 1 and 2 exactly know how I'm marking them up. And also Ali, you should know because support and resistance lecture was aired. Everybody saw it. So guys, this is my normal support and resistance. I'm marking my support and resistance levels on uptrend and downtrend. Then I'm adding on my supply and demand levels, guys. Just major ones, guys. Just major ones I focused on. I don't like to focus too much. I don't want to make my charts fill with them to miss the plot. That's it, guys. That's it. That's all I need. Now remember, now let's see. This move to the upside was the strongest, right? Remember, guys, the price was here. Made a double bottom. Bullish engulfing on a demand zone established from already support level, right? What I teach you is this. You saw the break of this. This is your first point of reference as far as the candles are concerned. We do not like to trade here. We want to see the break of the trend line, and a double bottom. I teach you the double bottoms and double tops previously. One bottom, two bottom. The price has breached this bullish bullish momentum, strong bullish momentum, right, guys? But then see, the price went down. This is a consolidation zone. Now, this is important to see, guys. This zone is consolidation. The price went down. Strong move to the downside. The price, the indicators showing price came down. The price went up around this area, guys. Will I start buying it because of just this? Absolutely not. What I taught you today and previously, wait for it to come down again. It came down again. I want to see a price making a lower high, guys. Price came down. Leave my analysis, primary analysis. We already marked it. Focus off on the RSI. I'm teaching you RSI. Now see this. The price closes almost same level. Wait for the price. Price went up, closes above. So this is making higher lows now. We are still in accumulation. There's no movement here, but here you can see the price has started to make higher highs, higher lows. It's easy. This is divergence. Can you see? This is divergence. On your indicator, mark your line. Remember, the price breaches this line. Divergence failed on your indicator. Now, this is divergence, but still the price is here. Remember, my entries are based on the price action, not on indicator. But this gives me another reason. Watch this area. Now, price breaches this trend line. This can be your entry, guys, confirming double bottom, right? Then price went up. Weak holders moved the price down. This is your controlling candle. Remember, I taught you in lecture 2. Price did not break it. Stay in the trade. Mark another trend line, guys, the way I teach you. You need to breach of this, 2 lines. You need to breach of this to confirm move to the upside. The price will stay in the trade and mark your reference line. Mark your reference line like this. Understand? I taught you already all of this in the lecture 2 in huge detail. Remember, guys, divergence had told me possibility. I don't like to see anything else. Shut your indicator down. Focus on the primary analysis. The price breached this. I'm very happy. Breach this, going to the upside. Confirmed. Further confirmation, guys. Now the price is accumulating here. Let's see. Go back to your indicator. The price is accumulating here. So if you just trade based on indicator, guys, then you should be selling here, right? Lower highs. You should not be selling like this. Entries and exits, the strong trend. Entries and exits hats, you can add on the indicator divergence, but do not use it to continue staying in your trade. No, not at all. Remember, if you had gone price make a lower high, then lower high, if you had just sell it based on this divergence, the price gone up. You cannot trade with the indicator. Secondary analysis, yes. So if I want to see this, I want to see this. This is your high and low support and resistance. But guys, all these candles are telling you buyers are in control. From lecture 2 of candlesticks analysis, I teach you already. Ali, we do not trade the candlesticks analysis the way you have learned from the books, the names and stuff. I have a totally different way of trading them. Al Brooks way. So based on my primary analysis, I will not sell it. Yes? Will you sell it? No. You will not sell it unless and until it reaches this, right? It reaches this. And then suddenly what happens? The price moves to the upside again, confirming. Right? Can you see now the indicators gone into above 70, showing the strength, ultimate strength. Gone up, gone up. Maybe I like to exit my trade here based on this zone. If I exit my trade here, exit and entries has to be on your prime analysis. Based on your prime analysis, indicator is also an add on, nothing else. I see this divergence, that is it. That's it, nothing more, nothing more. You guys understand the example that I'd given you again, adding on this divergence and adding on supply and demand zones on your charts? Do you understand? Tell me yes. Zain, Khudayar. Now I'm giving you another example of divergence. Remember, do not trust it. Price move to the upside. And this is divergence. When the price came below 70, this is divergence. Negative divergence, but remember, this is secondary analysis. All I see this, I say, okay, fair enough. I remember I would not even sell it. Look at this candle. Bullish, bulls in control, might go shoot to the upside. So my entry is not based on this. My entry is based on what? The price is in a supply zone. The first candle, can you see this? And I see the divergence. Now maybe what I teach you guys, reference line, you can go into 1 hour. You can always go into 1 hour if you like. Leave the indicator now. Forget indicator. Focus on your prime analysis now, guys. Price, the next candle fails to breach the previous. This is Harami pattern, but again, we don't focus on patterns again. Bearish candles, yes. The next candle fails to break the previous candle, yes, bearish. Trade confirm. I want to see a bullish candle. No bullish candle yet. Trade confirm. In the trade, yes. Maybe there I like to exit on this candle. Remember, one and follow up to the upside. I don't even get out of the trade like this, but I'm just saying maybe. But you can use your supply and demand levels for target zones. Remember, this was your supply and demand level, previous demand level. The price will aim for this, and exactly that what happened. On this candle, maybe you like to get out of your trade. It is good as per the rules. I taught you guys. Do not overcomplicate yourself. And remember, adjust your trend lines. I do not get out of the trade until and unless, but I will advise you to get out of it. Yes. How many pips? 180 pips, guys. 25 pips stop loss. Makes sense. I'm giving you example of divergence only. Remember secondary analysis. Remember, I'm yelling you guys on this. This is divergence. Divergence. Consolidation here, but don't divergence. Now I will trade with my reasons. Double bottom, bullish engulfing, triple bottom, bullish engulfing, right? Breaks of the trend line. Then as I taught you guys, use them. Reference. Split. Leave the indicator. I don't need the indicator anymore. So do you guys understand how to use supply demand divergence in your trading? Divergence indicator as a secondary analysis in your trading. Do you guys understand? Based on my first lecture and second lecture, I am just adding on, nothing else. Yes? Say yes. Zain, Khudayar, Ali, you haven't taken my second lecture. That was a private lecture. I just don't give to the people randomly. These guys have taken because they have been trained by. I've been training these guys along with others on my mentorship of 5 weeks. But then again, I wanted you to be present on this to learn a little. So do you guys clear on this? Remember again, your prime analysis, support and resistance. Your prime analysis has to be candlesticks analysis. Your prime analysis has to be supply and demand levels. You must know the reasons why I said we mark supply and demand zones on your chart. What is the difference between supply and demand and support and resistance? I had taught you in length. If I do not hear from you when I ask, I will be disappointed. And then again, divergence, relative strength index, what the indicator means, how do you should use it, if you use it. I don't even use it. Add on to divergence. Remember, do not trust it. RSI indicator or any secondary analysis indicators are only 50-50%. That is it. Nothing more, nothing less. 50-50. That's it. You don't invest your money on based on 50-50 probabilities, right? Primary analysis is gold. Any questions, guys, before I'm going to stop the recordings, and I'll take questions, but I want to stop the recording for the purposes of this lecture so that you guys can go and have it again. No, I'm not going to discuss moving averages in this webinar. Remember, again, this is a course specific. We'll discuss this. I'll discuss moving averages again. Again, a lagging indicator, not leading, a lagging indicator. I'll show you again later. Tell me, as far as this lecture is concerned. Any questions on the topics that I've discussed? So you have covered support and resistance, candlesticks analysis, supply and demand, divergence you have learned. Any questions? The next lecture is Fibonacci. Using Fibonacci support and resistance into your trading, adding on as an add-on. Fibonacci tool, which I'm going to explain you, is just a support and resistance. But the question is, when do we use them? Add on to our trading. I will explain it to you. When exactly you need to put the Fibonacci on your charts. That is it. Otherwise, you don't need it anymore. Keep it Fibonacci in your pockets. Use it when it's needed. I'll exactly tell you exactly why we use it. Yeah, you can draw them from the weakest reactions and the strongest reaction. Guys, let me stop the recording, then I'll take the questions. Okay, the lecture 3 has been completed. The course so far, supply and demand, support and resistance, and candlesticks analysis with secondary analysis of oscillator RSI, in which we have observed how to utilize divergence in our trading. Thank you very much. I'm going to stop the recording, then I'll take the questions. Give me a minute.